Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. With this video, I want to point something out that I think is very important and often misunderstood on Wall Street. Growth investing and value investing are not two different types of investing. Value investing applies to whether you're looking at growth stocks, dividend-paying stocks, or any other kind of stocks. When it applies to growth stock investing, it's commonly called GARP, or growth at a reasonable price. And today I want to take a look at a company that is a growth stock, has no dividend. The company is CACI International, and we're going to look at it rather comprehensively here through the lens of FastGraphs. I really like this stock for a couple of reasons. It really tells a powerful story about valuation and how, in the long run, earnings or fundamentals drive stock performance. So let's go ahead and get into the FastGraphs. What I've got on the screen right now is adjusted operating earnings for CACI International. And the orange line here is simply plotting earnings at a multiple of 15 times earnings. So this orange line is 15 times earnings for all the earnings that are listed here at the bottom of the graph. Now, a couple of things I want you to note is, number one is the company is what I would call quasi-cyclical, but quasi-cyclical as a growth stock. In other words, there are periods where growth kind of gets flat or even drops a little bit, followed by periods where growth gets more pronounced or advanced, followed again by some flat periods, again, fall over and over again. So it's a quasi-cyclical growth stock, we can call it. Now, one of the real issues here, the reason I'm showing it like this is because one of the things that FastGraphs really shines at as a research tool is it really gives you a picture of the company that you're evaluating and how it is historically operated. Now, it has some very dynamic features as well. For example, I'm going to knock a few years off of the chart here, and I'm going to see my growth rate is 11.38%. I'm going to drop a few more years off, and now all of a sudden it increased to 16.47%. But that was because we had this huge 80% year. As I said, it's a quasi-cyclical growth stock. Chop 1 year off of that, and I'm back to 10.79, or approximately 11%. I run this at 7 years, and I've got about 13%. But once again, I've got an anomalous year here. So what my point is, I'm trying to ascertain what is the growth potential of this company. And just by going through the exercise I just did, it comes out to be about a 10 to 12% grower, sometimes a little faster, sometimes a little slower, historically over time. So now when I go to forecasting, which I'll do in a minute, we want to see if the company is expected to continue growing at its normal rates or not. But here's the point. I'm going to add weekly closing stock prices to this graph. And the point I want to make is, and what FastGraphs does so beautifully, it shows how the stock price in the real world will track the company's operating earnings over time. So let's put weekly closing stock prices on the graph. Now, this also is how you learn about valuation, because what we see here is this started out with about a 19 PE ratio on the first day the graph was drawn here. The PE was 18.99. We'll call that 19. The current PE is 16.75. Okay, the company's growth rate is 12.19%. Now, you can see the earnings drove the stock price. When the stock price was well above the orange line, that created a period of time where the stock didn't do very well. It had a negative annualized rate of return, and I would attribute most of that to high valuation. And I can also pick times when valuation was low, like here in June of 2012, and just go fuse out here, even when it's trading at fairly value, and all of a sudden our rate of return is 21.87%. But what I really want you to notice, what I'm really trying to point out here is the secret of being a value investor is being able to fully participate in the company. If you have a company you admire and you think it's going to grow, you want to participate in that growth. If you way overpay for it, like here, back here just before COVID, you could have bought the stock at a 23 PE ratio. Now, if I use, again, the dynamic nature of the tool, and I use my scroll bar here, and I drag this up to the COVID period here, okay, what I learn is that the growth rate was about 13.8%. If I measure my performance over this time frame, because of overvaluation, I only made 7%. I did not, even though the stock was still kind of highly valued at the end here relative to historical norms. But when I look at this from the total perspective, from the max time frame, and I go ahead and look at performance, I want you to note that my performance was 11.58% over this time frame. Again, there's no dividend, so I don't have any dividend growth. And it outperformed the stock market over this time frame. But the key point that I want to point out here is, and that I'm trying to make with this discussion, is that the company grew by 12% a year, and only because of some valuation anomaly, the stock price tracked at about 11.5 to 12% also. So the point is, when you overpay, you get a little less than the company delivers. If you underpay or buy it at a reasonable price or underpay, you end up getting a higher rate of return than the company is capable of delivering. All right, so valuation matters, and it matters a lot. Now, another piece I want to add to this here is that the normal PE for this company over this max time frame has been about 16. So somewhere between 15 and 16 becomes a reasonable valuation. Anytime you can get it the valuation lower than that, as you see clearly by looking at the fast graph, that becomes a buying opportunity. Now let's look at the stock currently. Now let's look at the last few years here, from June of 18 to now, and we see that the company grew its traditional 10 or 11%, 10.79%. The market tracked that, but then we got this period of time here, starting in 2024, where the stock got really excessively overvalued. And now we've seen the stock coming down. Now, we're in a political situation here. I want to point this out, that because of politics and Doge and the idea of government spending and everything, that there's some risk here. But I don't think the big risk is Doge or the political spectrum that we're facing now. I think the big risk was that the stock had become historically significantly overvalued relative to historical norms. So anytime a stock is highly valued like that, there's risk involved. And what we see here is that fast graphs illustrates that risk probably as well as anything you could look at. You don't need rating systems. Was this an A for growth, a B for value? You could just instantly look at this graph and see that it was overvalued, and now it's coming into fair value. Now, I think the stock currently is fairly valued. I don't think it's undervalued, but I want to bring it to your attention because valuation is starting to come in alignment. And if you're looking for growth, this could be a stock that you want to put on your radar screen now. When you go into the forecasting graph here, you can see that it's expected to grow at 11.58%, pretty much more or less the same. If we look at historical compound annual growth forecasting calculator, we can see that this company, we can go to this historical compound annual growth window, and we can analyze what growth rates have been over the time, which I've already done for you earlier. And so double-digit growth is kind of in the cards. Now, the last few years, the growth rate has slowed down. All right, I want to make that point. And of course, when you got a high valuation like that and some slowing of growth, then ultimately you get in a position where the stock becomes vulnerable. Okay, but we are expecting pretty consistent growth over time. Now, I want you to notice something else about the forecast here. For 2025, there are 13 analysts. 6 months ago, they were forecasting $23.20 for this fiscal year, which ends in June, a little over 5 months away, almost 6 months away. They raised it to $23.51 3 months ago, and then the most previous estimate was $24.40, which is what the current estimate stands at. Okay, those same analysts for next year were forecasting $25.69, or about 10.66% growth. Then they went to $26.40, and then they're sitting at $27. Now, we lose a few analysts in 2027, but once again, the analysts we do have are showing increased confidence over time that this company's earnings are going to grow at 11 or 12%. The company has literally a perfect analyst scorecard. Okay, in other words, this company has actually met or beat analyst estimates. The majority of the time, it's had analyst surprises to the upside about 85% of the time. And you can see that by looking at the analyst scorecard here. So what we're looking at is a company that may not be quite in value yet, as a growth stock, but it's certainly getting a heck of a lot closer over the last 6 months or so than it has been over the last 7 or 8 or 9 months ago. And that's why I brought it to your attention. I think you should put it on your radar screen. Now, the adjusted operating earnings are one way to look at it. You can also look at it with GAAP earnings by looking at diluted, and you get a pretty similar picture and a pretty similar story. The company does make some acquisitions, so there are some accounting issues that are a little different with diluted earnings. But if you look at it from a cash flow, even though this company doesn't pay a dividend, it also has grown cash flows rather strongly. They did have a down year in 2022 on operating cash flow. From a free cash flow to equity standpoint, they're also growing free cash flow to equity by about 11%. So they've got strong cash flows. And you can look at these other metrics that are available for you to evaluate, which I like to often use EBITDA, earnings before interest, taxes, depreciation, and amortization. It does show the high valuation, but the stock coming into a better valuation. And then we see the same thing again here with EBIT, earnings before interest and taxes. We see the valuation coming into alignment. We're starting to see a lot of that, by the way, recently, and I'll be talking about more of that in future videos. The company's price to sales at 1.06 is actually a little high because it's historically traded at around 0.8 times sales or lower. So this would be an indication that the valuation is still rather strong, although it looks a little better when I shorten the time frame because sales have grown a little faster, and over the last 5 or 6 years, it has been trading at about the same price to sales it's currently trading at 1.09 versus the current price to sales of 1.06. Okay, now there's a lot of other ways to look at this stock. We're going to go into fiscal fitness here real quickly, and I do want to look at all important margins because I think that's something that you always want to evaluate. And what I see here is very consistent gross margins, somewhere in the 30% range. I see very consistent operating margins, and I see pretty consistent net margins also, and they're typically above industry standards. Now, we've looked at the thing dynamically through the fast graph. Let's go into the company's website now, and let's actually take a look at what this company does and who they are. So they've got a neat little tab here that says what we do. And so let's explore the things that they do. The company is in this command, control, and communications intelligence, or C3I, command, control, communications, and intelligence. And they were just awarded a $1.2 billion naval war contract. That was a pretty big contract for them. We can also look at the fact of cyber. The company develops and delivers cyber technology solutions and security expertise that empower their customers to conduct both offensive and defensive operations, defend their critical infrastructure, and maintain information dominance. And cybersecurity is obviously pretty critical in today's world. They also do digital solutions. They transform organizations using agile methodologies and advanced analytics. I'm just going to go through these briefly just to give you a little feel. Mission and engineering support. They have unparalleled expertise and exquisite skills, making CACI a steadfast and trusted partner to intelligent defense. The reason I'm also pointing this out, the risk I think here, a lot of people are concerned about DOGE. Based on what the industries this company operates in, I don't think they have a lot of risk of being cut by DOGE. These are going to be areas that the current administration is going to be very serious about maintaining. All right, so the company is a very interesting company, and they do offer mission-critical operations. And so let's talk a little bit about where the company stands competitively in its industry. Its largest competitor, it's either Leidos or Leidos Holdings, I'm not sure how to pronounce it. It's also growing at about the same rate recently. This company does pay a dividend. They paid a special dividend. Leidos has about 40-some plus, I think 41% of the market share, where CACI only has about 21%. But CACI is an $8.6 billion company, and their big competitor here is about a $19 billion company. All right, so there's a little bit difference, but this company does, CACI does operate very competitively in the various categories and industries. They do have some special expertise. Now, other major competitors would be companies like General Dynamics, Northrop Grumman, Booz Allen is another big one. Hamilton, Booz Allen, Hamilton. So competition is something to think about here if you're looking at this. And that's one of the big risks in the stock. But I also think you want to take a look at the fact that I've gone through some of the fundamentals here. We're approaching fair valuation. So you might be wanting to put this on your radar screen. If it gets a little cheaper, I'd call it a buy. Right now, if you have it, I'd call it a hold. Okay, but this company is also pursuing several growth strategies. They have an emphasis on software development and agile methodologies to enhance efficiency. They've made several strategic acquisitions, such as Azure Summit and Applied Insight. They're investing in emerging technologies like artificial intelligence and cloud solutions, and that's obviously a big plus in today's world, artificial intelligence especially. Now, the company does have a lot of market volatility, which you can clearly see here, and you can see the fact that that is mainly referencing this period here. But I consider that a vulnerability based on a very high valuation. Okay, now some other risks to consider. The company is very dependent on government spending, and that can impact their revenue. And some people are worried about Doge, although I don't think Doge is going to be a big factor to them. The company does carry a little bit of debt, but not bad. I think they have the cash flows, as I showed you earlier, to support that. And so I think it presents an interesting opportunity for value and growth investors. As I said earlier, growth at a reasonable price. From a value perspective, it's still just a little bit higher. I'd like to see it down here at this orange line. In other words, I'd like to see it at a 15 multiple or lower. But that doesn't mean it's not attractive at these levels. If it does grow at 11 or 12% and sold at a 15 PE, it would generate a total return of about 6.5% annualized, which again, I'd like to get it a little lower, because if we get it lower, that'll run that return potential up to 11.5 or 12%. All right, now, again, there are risks, and you should be aware of the risks. In addition to market volatility, I already mentioned you have intense industry competition with some major competitors. We've got the dependence on government spending, and debt would only be an issue if interest rates rose, and I think that's where they're going the other way right now. They are the second largest in the industry with about 21% market share versus Leidos of 41%, so they're big. Now, the company does derive over 95 or 6% of its revenue from government contracts, including contracts with the Department of Defense, intelligence agencies, as well as some federal civilian agencies. But the specialization in government and defense sectors is a key differentiator for this company, compared even to a lot of their competitors. And again, they have things like electromagnetic spectrum and photonics, investing in electromagnetic spectrum, cybersecurity, joint all-command and control. Competitors like Leidos, Oracle, Jacobs, and SAIC also focus on these modern technologies. But the bottom line is the company has won several recent contracts as well. They have a approximately $35 million contract they've just secured with the Air Force, a $61.7 million EITaaS Wave 1 contract with the Department of the Air Force, an 8-year, $2 billion contract with NASA for IT support, a prime position, about $1 billion U.S. Army R4 multiple award contract. They also have a $2 billion task order for modern digital solutions technologies. However, they have had a setback with NSA's $2.4 billion Focus Fox contract, which was protested by their competitors and is leading now to a reevaluation. But the company still demonstrates several strengths, and they've won several contracts. And so all in all, I like this company as a long-term investment, but I would like it better if it got a little cheaper. But I did want to illustrate how the stock is tracking the company's earnings, and that's the beauty of fast graphs again. This is the real world. Okay, this is not speculation, what's a good valuation metric. You can look here and see what good valuation is and what attractive valuation is. So if the company's stock price fell further, then I'd consider it a very strong buy. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs. I did something a little different here. I do like growth stocks. My forte has been mostly at my age and most of my clients' age in my money management business for dividend growth. But I do have clients that like to see some earnings growth and some pure growth stocks as well. So I'm going to be covering some of those this year in some future videos as well. But I want to illustrate how the Fast Graph tool helps you analyze these kind of companies just as well as they do the dividend growth stocks. Thanks for watching. If you haven't subscribed to the channel, please do. If you like the video, give me a like, ring the bell so you get notifications of future videos, and take a look at Fast Graphs, one of the most powerful investing tools, giving you an instant perspective of how attractive fundamentals are relative to a company's stock price instantly at a glance. Thanks for watching, and I'll talk to you again real soon.